Welcome to the podcast that's dedicated to helping business owners to prepare for exit so you can maximize value and exit on your terms. This is the Exit Insights podcast presented by Succession Plus. I'm Daryl Bates-Brownsword, and today I'm talking to Jason Parr from Peisner Johnson. These guys, Jason is a sales tax expert, and he has been shocking me and basically blowing my mind with all the various combinations and difficulties you can get into when selling your business. So, Jason, look, 10 seconds, quick intro into yourself. How did you get into being a sales tax expert in exits?
Well, you said that right. I've been with Peisner Johnson. We call ourselves the sales tax people. I've been with Peisner Johnson for 27 years. So state and local tax, and especially sales tax, is all I know. And it's just in the last 5 years that it's really become critical to understand what your responsibility might be around sales tax, especially upon exiting a company.
Okay. And this is this conversation today is pertinent to US-based businesses. But these issues that we're talking about, I guess they spread when businesses have got international operations as well.
It's correct. So any company anywhere in the world doing business in the U.S. Could be subject to a responsibility to collect and remit sales tax. And not understanding that responsibility and not complying with that responsibility can create a significant liability or exposure on the company in the process of doing some due diligence when you're looking to sell your company, or if other individuals are looking to acquire your business.
Okay. So I'm guessing if someone's interested in acquiring a company, we go through, we have a look at the company. If we're the seller of the company, we prepare our business and prepare for due diligence. But from a buyer's perspective, they've now got legal due diligence. They've got cultural due diligence if they want to make sure that the business is going to fit their portfolio. And they've got all sorts of other types of due diligence. Now, it looks like we need a sales tax due diligence as some special research. Otherwise, there's another gotcha there for us.
Yeah, unfortunately, it's the landscape has changed quite a bit. Just to give you some brief background, just 5 years ago, in fact, this month, we celebrated the decision in the U.S. by the Supreme Court of Wayfair versus South Dakota. And Wayfair versus South Dakota was really a sales tax question that was taken to the Supreme Court to determine, can a state like South Dakota require an online provider of goods to collect the South Dakota sales tax on those sales and remit it to the state. Every state has its own sales tax law, and because of the state and federal guidelines related to interstate commerce, states typically can't reach across state lines and require taxpayers outside of their state to collect a sales tax. So prior to Wayfair, which was July of 2018, everybody who did business had to comply with sales tax law based on where they were located. Now, because of this new law that's passed, everybody that does business in the U.S. has to collect tax based on where their customers are located. So you can imagine in an e-commerce world where you're selling goods all across the U.S., Canada, across the world, in fact, all of a sudden you need to worry about all of your customers that are located in multiple states. And so where a company might have needed to be registered and collecting sales tax on their goods and services in a particular state, maybe they were registered in 1, 2, or 3 states based on employees or inventory or places of business in multiple states, but now they may need to be responsible for collecting tax across 45 states that impose a sales tax law. And so it's really created some confusion and some complexities across the country. And so there's 3 questions. We just try to simplify it so you can understand what your responsibility is. And we break that down into 3 questions. Number 1, state by state. Do I have nexus? That's the term in the U.S. to determine if a state can require you to collect a tax on their behalf. is what I sell taxable, right? If a state can require me to collect tax, then I need to know if what I'm selling into that state is taxable under their sales tax law. And then lastly, am I the responsible party to collect that tax? Along with every law that has passed in each state requiring out-of-state sellers to collect an in-state tax, they've passed what's called marketplace facilitator legislation. And what all that means is now if I sell on Amazon, is Amazon responsible for collecting that tax or am I responsible for collecting that tax? And so you have to look state by state and answer those three questions to determine, okay, number one, do I have a responsibility here? And if I do, how do I comply? And if I do, if I haven't complied when I should have, those sales taxes add up over time and really are the costliest mistake you can make when it comes to sales tax, because it's not that those taxes aren't due. Now they may be due out of your own pocket with penalty and interest across multiple states.
So this really puts an added burden on business owners. So if they're a
It
mail
does.
order business of some description and as you say, selling on Amazon or eBay, I imagine, or even just some sort of online through their website, if they get a customer, yes, one customer from another state, does that create the liability for them?
Yeah, that's a great question. So the first question is, do I have nexus? Each state that has passed legislation that would require this have also passed economic thresholds. And so in the US, you'll hear a lot about economic nexus, and that means that my sales into a particular state need to exceed a certain threshold before I'm required by that state to register and collect tax. Most of the states in the US now are around 100,000 in gross sales into the state. There are some larger states that may have a $500,000 threshold. So there is a protection for what I suppose the South Dakota and the Supreme Court um, determined would be small businesses. So if you have sales less than 100,000, then you may not have a responsibility in that state to register and collect that tax. So there are some minor protections based on the number of transactions or the amount of dollars sold in a 1 year or a 12-month period.
Okay. And you've already mentioned that the number, the threshold is different in different states.
It is different. The most common threshold is 100,000 because that was the law in South Dakota that the U.S. Supreme Court said was fair. And
Okay.
so that hasn't been litigated in other states. And because it was deemed fair in South Dakota, most states just mirrored the same law that South Dakota had in place. Texas, California, New York, some other states that are larger have larger thresholds, um, just because it's also a burden on the state to actually require smaller sellers to comply. They're really looking for the larger sellers. And once they pass the law for the Amazons, the Walmarts, the Etsy's to be the uh, responsible party to collect the tax, and that took some additional burden off sellers. But it doesn't take away some of the complexity, because if I sell through Amazon and I sell on my own website, Amazon's responsible for collecting tax on the goods I sell through their platform, but I'm responsible to collect tax that I sell through my website. So it can be complex and definitely needs to be looked at. The last thing you want is you've worked really hard to build a business and you're ready to sell that business, and you find out under sales tax law in most states, the purchaser of a company is the successor of the liabilities on that company. So if you're buying a company that has not complied with these new sales tax laws, and you may find out that you have a seven-figure exposure in the US, which you may have wanted to put in reserve or an escrow, or actually could have killed the deal, so to speak, could have put you in a position where you don't want to buy that company until they have corrected those things and they are in compliance, so that when you succeed as the owner of that company, you don't bring all of that potential exposure with you.
So that's, as you say, it's quite a burden. And I think you mentioned if I'm selling through Amazon, then Amazon has the burden of going, okay, you've done 100 grand worth of sales in this area, this state. Therefore, we need to collect the sales tax and allocate it for you, and we'll account for it for you. And then you mentioned that I might also be selling directly from my website.
Mm-hmm.
So if I sell, I don't know, let's say 100 grand through Amazon, and they start collecting the tax, does that mean every dollar of sales that I sell directly through my website, I need to start collecting the tax, or do I get another 100 grand worth of credits?
That's a great question, actually. You bring up a subject that makes it, again, more complex, but each state, so when you're looking at that $100,000 threshold in each state, some states look at your total gross sales, no matter what platform or what channel or what avenue that you sell it. Some states are only looking for those sales that are deemed taxable in their state once those reach 100,000. There are a few states that actually, when they're looking at that $100,000 threshold, they will exclude uh, marketplace facilitator platform sales. And so it could mean that you're just looking at all sales through Amazon and your website, or you're just looking at sales through your website. So you have this is why when you're doing this, you have to look at it state by state, because each state is able to impose the law based on how they deem it should be imposed.
It sounds like a nightmare. Um, so,
It's simpler than our discussion here, especially if you get a sales tax professional involved and just helping you understand the layout and what the situation is. Because if you looked at a spreadsheet and you tried to say, where do I comply, where do I not have to comply, where do I have a responsibility or not, it can seem very complex. But if you're going through that spreadsheet with a sales tax professional, you can get a really good idea of which state you need to comply with. And then when you partner with that professional as it relates to your ongoing monthly requirements to remit the taxes that you're collecting, then each month you continue to have an understanding from that
yeah.
professional where you stand in each state.
Yeah, and I'm naturally being a little bit of a devil's advocate and just trying to
Oh,
ask the
sure.
questions that must be going through. Someone who's servicing clients in multiple states. It'd be the question that's going through their head. If they started their business 20, 30 years ago, they've been running their business. They're used to running their business a certain way, and then all of a sudden, like 5 years ago, things are changing. And especially in that last 5 years, if they're starting to think, well, I'm getting to
Yeah.
the stage where I'm thinking about what's next, this new requirement has come in sort of in their minds maybe backdoor. Hopefully they're working with a good accountant. Their accountants kept their eye on things and kept on top of it and sorted it out for them along the way. But Jason, the question that comes to me is this the sort of thing every accountant can handle for their clients, or do you need some sort of specialist qualifications?
What we're finding is there are accountants and CPAs who have dealt with federal tax, U.S. federal tax, state income tax, but when it comes to the sales tax side, they either don't have the background or the knowledge, or they simply don't want it. Uh, we we work with a lot of accountants and CPAs, bookkeepers, fractional CFOs, and others. The most common phrase that we hear from them is, "I hate sales tax." They don't want to deal with it. But your trusted advisor has to be cognizant of this, because let me just give you an example of what we see from time to time with companies who are not aware, or who have accountants who say, "Don't worry about sales tax. It's not that big of a deal." So if you just think about, let's just say that you've been selling in the U.S., whether you're doing it on Amazon, your own website, brick and mortar, whatever the case may be, there's no doubt you now have a responsibility to register and comply in more states than you previously did. Let's just say it's 10 states, not all 45 states. And let's say that that's happened over just the last couple of years because you've expanded or grown. Let's say you've come out of, or during the pandemic, you really had the ability to do a lot more online sales, and you're coming out of the pandemic, and that's just been exponential, or you've grown and grown. So just let's say 10 states. Most states have an average sales tax rate of anywhere from 6% up to 10%, which doesn't seem that high when you think about a VAT or a VAT in international on all goods and services. But this is just one tax type. But let's say that you weren't aware of your responsibility, so you didn't register, and then these 10 states understand that this has actually happened. Well, let's say you've had $1 million in sale in those 10 states. So you've had $10 million in sales. And let's just say the average is 8%. You have about $80,000 in tax that should have been collected that was not collected. And you likely have upwards of 20% or more in penalty and interest that would be imposed on that. And this would be $100,000 coming out of your own pocket. If you run an online business that has 10% margins, or worse yet, 5% margins, your entire margins for an entire year or for 2 years have been completely wiped out. And there's companies that run into this type of situation. That's a $1 million liability on $10 million in sales across 10 states. You're dealing with 10 different administrative taxing authorities. And now you owe this with penalty and interest, and the likelihood is you don't have this money. You can't go back and collect it from your customers later. And so a lot of companies either have to take out a loan to pay these taxes out of their own pocket. They also have to then get registered and start collecting tax and remitting tax. And so they have an administrative cost associated with going forward business. But sometimes if your margins are smaller, or this has happened for 3 years or 4 years, you're now in a situation where you have seven-figure liability exposure, and it could either cost you through loans, it could kill the sale that you're trying to make. It might even put your company out of business, which is the saddest thing that we see from
Yeah.
time to time. States don't want to put companies out of business because they're ongoing tax revenue as they sell their goods into the states. But sometimes a company has met this type of exposure, and they have no way to manage that, or maybe they're going to be paying that out over the next several years. So we call it a margin killer if you're not aware of it and taking care of it. But here's the thing, the most costly mistake you can make is to ignore it, right?
Yeah.
Okay, I know I have some exposure. I know the situation in the US, and I don't want to face it. Every month that goes by that you don't comply with the law just continues to build that potential exposure. And so it's really, really important to face it, deal with it. There are ways to try to mitigate the tax out of pocket, to get those penalties waived, to get the interest waived. There are programs, every state has them, to voluntarily come forward and to correct your situation. And we help companies do that on a daily basis.
Yeah. It's just scary, the complexity of it all. I can imagine our listeners in Australia going, hey, look, we don't like the GST, the goods and services tax. It's a flat tax. It's 10% on everything. It's fairly simple, but it's still a 10% burden. In
Yep.
the UK, where we're based, it's 20% VAT. It's just a fact of life, and it's 20%. It's fairly simple. It's fairly clean. It's consistent across the UK. So that makes it easier to manage. There are different levies and what have you for different industries that in like construction, which can make it a little more complex. But man, it's nothing compared to what you guys have got over there.
Yeah.
So all of a
Yeah.
sudden, tax is good. Said
No
no
doubt
one.
about it. Yeah. Anytime the government gets involved to make something more simple, you can almost guarantee in the US it's going to become more complex.
Okay. So look, given the nature of entrepreneurs, and you may or may not know the answer to this one, Jason, but given the nature of entrepreneurs and new ideas, um, Has anyone come up with any insurance to protect against this yet that you're aware of? I'm just exploring ideas that entrepreneurs can go, hey, look, I'm in a risky situation here. I'm not doing anything deliberate, but I just
Right.
want to protect myself in case I've accidentally strayed into some muddy waters.
Yeah, there's not really insurance that would cover it. Really, it's getting up to speed on the different laws and then compliance. And again, I mentioned the programs which allow you to come forward. And what the state will do is they'll limit how far back they look and require the
Right.
tax. Most of these programs will waive the penalty, so you don't have that extra 20% that can sometimes be incurred. Some states will also waive the interest. Depending on whether your sales are B2B, you may be able to go back and request tax on past sales that should have been collected that weren't, and sometimes you'll have customers that are willing to comply with that. That's a tough one. If it's B2C, it's almost impossible to do that. Also, what we do on a daily basis is we meet with owners in companies to understand what their situation was, and just collaborate on what's the most practical approach to managing this situation and trying to mitigate or reduce the actual amount of tax out of pocket. And we do that successfully quite often in reducing the amount of money out of pocket and helping a company get compliant across all the states that they are required to be compliant in, but not lose their business, not lose their margins, not lose the sell, so to speak, in a due diligence type situation, and effectively get them moving correctly going forward. Um, I think that's the real key. That's the only insurance policy is try to understand it as best you can. Get a good professional involved with you, collaborating with you. One of our primary values is collaboration builds confidence. You can really spin your wheels thinking about what to do in different situations, and but once you collaborate with somebody, you gain a little bit of confidence in what the next step is and how to move forward. Especially if there's a practical approach, there's a conversation that says, here's what the state says, here's what they would expect, here are some of the remedies that are available, here's what we recommend. And a lot of times that's a combination of doing one of these programs. Maybe it's a historical registration and managing the tax. Maybe it's going back to customers. Maybe it's just a prospective registration, meaning let's register today going forward, stop the bleeding, be compliant, and manage the historical situation if necessary. So there are some different remedies that you can follow, but you just want to be able to talk to somebody who understands the lay of the land and what the states would require, and what some of the more aggressive states are in comparison to states that, they're just happy you registered and
Yeah.
are compliant going forward.
Okay. So, Jason, this is a landmine potentially. Um, we're going to put all of your contact details in the show notes. So, if any of the listeners out there are sort of got any questions and just totally confused by all of this, are you available for them to reach out and at least get an inquiry going and get some advice of how much help they do or don't need from someone like yourself?
Yeah, absolutely. In fact, it's some people can kind of feel like it's a little bit of a cheesy name. But we do free consultation, and a lot of times when you hear free consultation, you're like, oh man, there's going to be a hard sell at the end of this. So I've got to sit through and collaborate, but then they're going to really be a hard sell. It's not that at all. It really is a free consultation, but it's called a what's next call. Because what we find out is as we educate individuals about sales tax issues or situations that may relate to them, they learn a little bit about us, and we really want to learn about their business operations so we can give the best recommendations possible. But we have a conversation just like you and I have had today,
Yep.
but it's based on their business, and we line out what the possible recommendations may be. If they walk away from that with greater confidence and some peace of mind as it relates to sales tax, we're perfectly happy. And so there's no hard sales call. It's really an opportunity to collaborate and to share knowledge and educate on the issue so that people really feel confident about what the next steps are. But every time we do this, the question to us is, oh man, what do I do next? And so
Yeah.
that's why we call it a what's next call. But it's super easy to get on a what's next call. You just go to
Brilliant.
www.p as in Peisner, J as in Johnson, .tax. And that takes you right to the form where you can submit a little bit of information about yourself and set up one of these calls to talk about your business completely customized to what your situation might be.
Yeah. Well, we'll get all your details in the show notes. So if anyone wants to click on that and find out, that'll be readily available. It's critical because if someone's looking to exit their business, if they've been building their business over a number of years, we don't want any gotchas at the last hurdle
Yeah,
that'll stall their exit and then potentially crash things and we don't want to even be thinking about that, what could potentially happen to their future if they're reliant and dependent on certain revenue coming in at point of exit and sale of
for
their business.
sure.
So we've
Yeah,
got to get on the front foot. We've got to prepare. We've got to know what's happening, and we've got to make sure that if everything's ready, so that when we are having those due diligence conversations, there's no skeletons in our closets coming up.
yes, 100%.
Jason, look, I know we've covered a lot of ground, but just want to give you the last say. What's the number one thing that you really hope that clients take out of our conversation? We've already got your contact details. What's the key take home that you'd love them to remember from our chat today?
Do not put your head in the sand. The most costly mistake is to ignore this and not try to understand what your responsibility may be.
Brilliant. Hey, that's a nice way to finish. Jason Parr, Peisner Johnson, thanks for sharing your exit insights with us today.
Thank you, Daryl. It's been great.